The private markets are opening to the public, and one company is at the center of this seismic shift, Apollo Global. Its CEO, Mark Rowan, says the next great investment frontier lies not on equities, but in the vast private markets that underpin the majority of our economy. He sat down with us and gave us an exclusive look at how alternative private investments will soon find their way into the public's hand. This is Inside Alts. More than anyone else, you have pioneered, innovated, disrupted the whole notion of private markets. You've said that our whole idea of managing wealth, of investing, is essentially broken or certainly misguided. What do you mean by that? And more importantly, when did you first start seeing the true potential of this market?
So I do think it's broken, and it's not just people have overlooked it, but we have to think about what happened along the way. 2008 to me was the seminal moment when everything changed and things started to become clear, because if you think about the large private capital firms, not just Apollo, but our peer group, we were all roughly the same size in 2008. We were all roughly 40 billion of assets under management. Today, just for Apollo, we're 840 billion. Think of how fast that's grown, faster than Google, than Amazon, than Microsoft. And I'd like to attribute that to good management, but that wouldn't be true. The answer is there are just fundamental factors that are reshaping and growing private markets, and it starts with the notion at which I talk to advisors and clients all the time. What if we're just wrong about how things work, and nothing works the way we think it works? And that's kind of where I think we are today in the world.
And when you say wrong with the way things work, I mean, we have public stock markets up 20% plus in both 2023 and 2024. We're on track despite everything that's happening this year with another up year in the stock market. Bond market correlation to stocks has in some senses broken down, but that's still been, we're still seeing pretty high yield there. A lot of people who invest for retirement, the huge amount of retail investing that's come into public markets would say there's nothing at all wrong with the way we invest and the way we plan to retire.
I think it's sometimes difficult to have, kind of luck for, good strategy along the way. So one of the things I point to, we think when we invest in the stock market that we're investing in this broad swath. The reality is 8,000 companies that we used to have in our public markets are now 4,000 companies, and it's going down, not up. We have the S&P 500. When we own the S&P 500, do we actually own the 500? Well, we do in some way, except 10 stocks are now 40% of the index. So long as those 10 stocks keep going up, the index keeps going up. Those 10 stocks revalue, the entirety of what we think of as diversification will disappear. We have stocks and bonds now fully correlated. We have lost the ability, if you will, to really invest in a way that reflects the strength of the US market, or quite frankly, the strength of any market. How we used to invest, active management, we would choose those who produce good returns. The reality is active management is very hard. 90% of the equity market participants have failed to beat the index for 20 years. It's tough. We've moved to a passive world, we've moved to an ETF world, we've moved to everything being indexed and correlated. And if you want real diversification and you want returns, you want to participate in 80% of the economy and 80% of the job creation, you now need private markets.
And when we look at the history alternatives, I go back to sort of what Dave Swenson did at Yale. And so even at that time, this was in the 1980s, right? So, alternatives were this tiny corner of the market. It was hedge funds, it was private equity, it was venture capital. And he brought it up to 45% for the endowments, but it was really institutional investors that were playing in this fairly small space. What does the word alternatives mean to you today? And how should investors think about it? And when I say investors, I want to start with sort of family offices at the top of the pyramid, high net worth investors, and then retail investors. We can go through those. But when you hear the word alternatives, what does it mean to you, and what will it mean in 5 years?
So what it means to me is simply an alternative to publicly traded stocks and bonds. But I recognize that for the vast majority of the investing world, the financial press, alternatives means what it meant 40 years ago: private equity, venture capital, and hedge funds. We had this notion 40 years ago that private was risky and public was safe. What if that's just fundamentally wrong? What if private is both safe and risky, and public is both safe and risky, and they're just differing degrees of liquidity? That's the world I think we're in. And what started with Swensen and what started with institutional investors investing in old-style alternatives, that powered our entire industry for 35 years. We were serving one little market, the alternative bucket of institutional clients, and now we have this other thing, call it individuals, that's going to be as large as the alternative bucket. And now we have another market called insurance. People have watched what we've done with Athene, where we just harness the ability to invest in illiquid assets for excess return.
So you believe that individual investors on a dollar basis or market size basis could equal at some point institutional investors?
I think it's going to happen. And the pyramid you reference is the pyramid that I reference. At the top of this pyramid are family offices. Family offices are now greater than 50% private, which does not mean alternative in the classic sense. It's just they have moved forward in their view of the world. The next level down is high net worth, which doesn't have a real definition, but think of that as clients who are advised individually. They are getting access to institutional quality products, not just old style alternative, venture capital, private equity, and hedge funds. They're getting access to yield. At the same risk reward versus public markets, they're getting excess return. And now we have the beginnings of an opening for the vast, vast majority of investors to participate in private markets. And my own belief is that they are not going to participate in private markets directly, but they are going to participate in private markets indirectly, in many ways through firms that they have a traditional asset management relationship with. I think we're heading to a world of convergence. It's not going to be public or private. It's going to be public and private. And public and private, I believe, is going to happen sometimes in the same wrapper.
Yeah, and I want to get to that sort of merger of public and private markets because there's so many interesting things happening right now about that. I want to go back to how individual investors are thinking about this and the typical criticisms of any kind of alternative investment. Number one, there's a lack of transparency. Number two, it's illiquid. Number three, the fees are high. And number four, the returns, which have been good for a long time. Now that whenever you have a lot of money coming into one type of investment, returns tend to go down. So let's start at the top of that.
maybe go backwards.
Yeah. So how do you address those concerns that you've probably been hearing for decades?
For me, unfortunately, it's 4 decades.
Okay.
But just to address. So in the most recent information study that's compared public and private markets, private markets have outperformed public markets only for 21 of the last 22 years. And will that change as more money comes in? I don't know, because more money is not just coming into private markets, more money is coming into public markets. Everyone wants to have bought NVIDIA 5 years ago, but we don't get that opportunity. So it is always each day about the best thing we can do on the margin. I do worry about money coming into markets, but I don't think that public or private are any different in that regard. And then on the other 3 criticisms, first on fees, I don't think anyone's really looked at fees over a really long period of time. You have a choice every day. You can get something for free. Maybe that doesn't have any value. Or you could pay something and get something that has value. If private markets do not produce excess returns after fees at the same level of risk, they should not exist. An investor should never take a private alternative to a public alternative if it's not producing excess return per unit of risk. So net of fees, the performance of private markets has outperformed public markets. Are fees higher in private markets? Yes. The fundamental difference between a public market asset manager and a private market asset manager, a public market asset manager will take any amount of money you give them and invest it because they get to buy what exists. And what exists reflects 100 years of creation. A private markets manager takes your money, and if they take too much money at one time, they won't invest it wisely. We only get to invest in what we create, what we originate, what we find. Therefore, we are definitionally going to be smaller, and need to work harder for each asset. And so does it cost more to create? It costs more to create than simply to buy what's there. Neither one is right or wrong, but excess return per unit of risk after fee is what we need to do. In terms of transparency, we are moving to a market that I believe, first in the fixed income area, we will be daily NAV. My guess at year end across the vast, vast majority of our funds. In some of our funds, we are daily NAV as of today. Every single day, an investor can know exactly where they are. They can pull up their holdings. They can see what's there. This notion of lack of transparency just reflects an idea that's rooted in 40 years ago history. It's just not the case.
Well, but we don't have the same level of disclosure for private companies, private borrowers, than we do for the stock market, which have to report quarterly earnings, anything that's material to the company, right?
Absolutely. But how do investors invest? Do investors buy stocks today? Or do they buy indices? Do people actually do the work? I don't think so. And so there's not that there's no information, there's just less information. And we've seen this take place over a variety of places in markets over time. Take the levered lending market. 25 years ago, the notion that levered loans would trade was a fantasy. How could they trade? Every loan was different. Every company was private. There were no benchmarks. There was nothing. One bank stood up and said, levered loans are going to trade. 25 years later, levered loans trade because this one bank made a market in it, and then other banks came and made a market in it, and lo and behold, we take for granted that the broadly syndicated market trades. We have ETFs, we have open-ended mutual funds, we have a series of products. We don't think of them as private anymore. This notion of what's public and what's private, I think, is in transition.
And do you think, I mean, some of that's been driven by what's happened to the banking system and regulations around banks. Do you think that perhaps if we enter an age of less regulation on banks, banks themselves are getting heavily into private credit through partnerships? You guys are partnering with certain banks. Do you think that's going to change the growth trajectory for private credit if the banks get involved and not solve the problem, but it changes for them?
I don't really think so, because again, it starts with this notion of maybe we haven't asked the right questions and maybe nothing works the way we think it works to begin with. What's on a bank balance sheet? Isn't everything on a bank balance sheet private credit? Loans to customers, private. Loans to companies, private. Banks are massive in private credit. Everything is private credit. The way most people use private credit, they refer to a small fraction of a market that is levered lending, which is sometimes an amazing activity, sometimes a risky activity. But one has to ask, risky relative to what? Is it risky versus equity? No, it's actually a risk reduction. And this is what most people miss. If you can get equity-like returns by moving out of equity and into private credit or direct lending, or however people frame it, you're actually reducing risk and roughly getting the same long-term return. Is it riskier than treasuries? Absolutely. Is it riskier than investment-grade bonds? Absolutely.
But presumably you're getting paid for, you will get paid for that even after fees.
But this notion of banks and private credit, this is another thing that has been set up in many ways by the financial press. The banking system is amazing, and the US banking system is the strongest banking system in the world, and we are it. We are 60% of all the capital raised in the world. Our banks are the strongest. They are dominant. They do lots of good things. A bank at the end of the day funds itself short through deposits. The bank is the most efficient way to borrow short. The bank is not the most efficient way to borrow really long. Other entities, insurance companies, pension funds, investors saving for retirement plans, are the perfect source of capital to borrow long. They don't want short-term investments. They actually want really long-term investments to amortize their promises to retirees. And that's what we have going on in the world today. Think about what we're doing. We are building energy. We're doing energy transition. We're rebuilding manufacturing. We're redoing our defense base. We're redoing our grid. We're redoing next generation data and infrastructure. Every single one of those things is long dated. They will, for the most part, end up outside of the banking system in the hands of institutional investors who have equally matched capital. That's where the growth comes from. And for us, even at our size, we're not a relevant part of the financial markets at this point. We attract a lot of press. People are interested in what we're doing because of this convergence. But as the largest provider of private credit, and in our terms, private credit goes from AA to below investment grade, we're just not a relevant market participant at this point in time.
And on that point, how big do you see the credit market right now? I see different measurements for how large the private credit market is today. What could that market be in 5 years?
So again, this is one of definition. If private credit is direct lending, levered lending, below investment grade, it's roughly a $1.5 trillion market. If private credit is investment grade and below investment grade, it's a $40 trillion market.
Today?
Today. The vast majority of what we do is investment grade. And that always shocks people. You know, how can you private credit be investment grade? Well, AT&T, AB InBev, Air France, Vonovia, Sony, every one of these borrowers is a private credit borrower. And what it's telling people is if you're the CFO of a big company, you had one source of capital a long time ago, the banking system. Well, then you developed another source of capital, the bond market. And now you have a third source of capital, the private market. It's just about choices. If something is short dated, you want to be in the banking system. If something is really plain vanilla, straightforward, you probably want to go to the public IG market. And if you need anything other than that which is available and it's long dated, you almost always want to be in the private market and negotiate your terms.
And when you talk about long dated loans and that different time horizon that you talk about for each of those types of loans, I want to ask you about liquidity, because this is another issue that comes up when investors say, look, you shouldn't get into alternatives because you can't access your money. And traditionally, you know, I cover family offices and the wealthy, they've been paid for that illiquidity premium. They've been paid to keep their capital patient. Now you're seeing these sort of hybrid structures which pretend or at least say they will offer you private alternative returns but still give you liquidity, which a lot of people like me look at and say, you can't have both. Can you have both investments in long duration loans and assets and get paid for that, but also be able to take your money out on a Tuesday?
Not on a Tuesday, but on a Wednesday maybe.
Okay.
No, the answer is it's on a continuum. In the investment grade private market, if you work with Apollo today and you want to be 100% private investment grade, every 30 days you can take 100% of your money out. Okay, is that as good as Tuesday? No, it's not as good as Tuesday. But if you don't have, as an investor, the capacity to bear 30 days of illiquidity, you should not be in private markets. And so I don't think we're going to be all public or all private. I think we will look at our public portfolio, and for the most part, that will be our beta. And then we will want some amount of alpha, and that alpha will come from going into private markets. One will be daily liquid, and I'll come back to that in a second, and the other will be 30 days liquid. Oh, and by the way, if I want a little bit of each in a converged product, I could buy a State Street ETF, which is 100% investment grade, a higher return than investment grade, and is daily liquid, but it is roughly 70% public and 30% private. And so I think I can't tell you what the final destination is of participation in private markets and liquidity trade-off, and maybe there isn't one final destination. But investment grade private is the most liquid portion of the private market. Below investment grade private is the next most liquid portion. It offers roughly 5% liquidity every quarter. And the actual liquidity in the marketplace is better than that. After all, how do we have direct lending open-ended mutual funds? How do we have direct lending ETFs? How do we have all of these products? And the answer is there's a market that's being made. And that's what happens. In our equity market, we're used to thinking of the stock exchange as a source of liquidity. It's not. We have market makers, Jane Street, Citadel, Susquehanna, Blue Crest, and others. Notice I didn't mention any of the big banks because they're not the ones who make markets.
Right.
So in the post-financial crisis era, these four firms and others stepped in to make markets. And I always ask regulators particularly, Who stepped in the fixed income market to make a market? And there's complete silence. The answer is no one. Liquidity in our public investment grade markets is a fraction of what it once was. By some estimates, it's a 30th. It takes 5 days today to sell an investment grade corporate bond. So are our public markets actually liquid? Or do we just have the perception of liquidity because there's a price that's available? Very quickly, you're about to have a price that's going to be available in the private market. It is not clear to me that, at least in the IG portion of the fixed income market, that over time we are not going to watch liquidity converge, and public will simply be beta, and private will reflect some amount of bespoke negotiation where, not so much for illiquidity, but for providing flexibility on term, which doesn't mean credit negative, it just means different, you will get paid excess return per unit of risk.
And how much alternative investment should a retail investor have? I realize this is a risky question to ask the chairman and CEO of Apollo, but I mean, responsibly, you know, you mentioned family offices have nearly half of their investment in alternative. That includes real estate, that includes infrastructure, that includes a lot of other things other than private equity and private credit. But as the retail investor starts looking at this environment where it could be part of 401ks, et cetera, and they're just trying to think, okay, I should have X amount, and maybe it's not 60-40 anymore, but there should be maybe some gold/Bitcoin, maybe some real estate. What's a reasonable sort of benchmark that you think retail investors and then high net worth investors should think about?
Well, let's first look at the case for why should retail investors, 401k investors, invest in privates at all. First is diversification. You are actually risk reducing rather than risk increasing by diversifying. The second is, everywhere in the world this has been done. Take Australia as the poster child, but it's true in Israel, it's true in Mexico, it's true in Chile. An extra 1 or 2% on a portfolio basis over the retirement period is not just a little better at retirement, it's 50 and 100% better returns because of the effect of compounding. So now you get to the question, and I have to dice it a little bit. Are we talking about alternatives or are we talking about private? Because if we're talking about alternatives in a traditional sense, we're talking about things that, while offering high return, are risky. That, even for institutions, is a relatively small portion of their portfolio, typically less than 15 or 20%. If you're talking about things that are private, you could have private AA, public AA. It is not clear to me that if you do not need liquidity on Tuesday, that you should think about public or private any differently. You should think about how much money you need and ultimately over time how much excess return you're getting, as opposed to some built-in assumption that private is risky and public is safe. I actually think we're going to get to a world where public and private are both risky and safe, and it's just a question of liquidity.
So if I look at the latest allocation for, let's say, family offices, they have, depending on who you look at, somewhere around 5% of their total portfolio now is private credit. It doesn't seem like that's been growing that fast for family offices. Do you think at the high end of that pyramid for investors that will grow? Or do you think 5% is sort of a reasonable amount that will cascade down even to retail investors for the private credit side? And again, realizing their differences.
So I think private credit, the way, again, we talk about it, is this below investment grade portion, and whether it's 5 or 10% of their portfolio, that feels like where people may end up. But if you're looking at a 60-40 allocation, which I think is how you think about it, you may still be in a 60-40 allocation, but how much of that 60 is going to be private and how much of that 60 is going to be public? How much of that 40 is going to be private? How much of that 40 is going to be public? If you are in an institution that funds itself very long, you will have a higher percentage of private. If you are a family office and you could bear illiquidity and you know what the income you want to create and you can create more income at the same risk rating, you will own more private. If you're in a retirement account and you are saving for retirement and you're not going to touch your money for 30 years, what risk do you want to take to get excess return? Do you want to take credit risk? Do you want to take equity risk? Or do you want to take a risk that you're not going to be able to sell it on Tuesday? Well, if you're not going to sell it on Tuesday for 30 years, why not get the extra 150 or 200 basis points of return? I think we're going to move to a world where people think about liquidity. How much liquidity do they need in their portfolio? And risk reward. And not this limit on public, this limit on private. It's going to take a long time to get there because we're all creatures of habit. We think, we wake up each day and of course private is risky and public is safe. It's just not true. Both are safe and risky. Of course one's non-transparent and the other is fully transparent. That's just not true. We are in a world that we've never been in before. The one business that I know is going to be a good business is the advice business. And so I always say this to advisors in particular. We're moving to a world, we used to have 3 flavors of ice cream: vanilla and chocolate, stocks and bonds, and a little bit of strawberry alternatives. We're about to move to Baskin Robbins. Gradations of each of these things. You as the advisor are going to show your clients how to do that. But it's going to force you to do a different amount of work, to learn a different amount. The value of advice has never been stronger, and we're moving to a place where investors are being asked to consider something new. Trust, alignment. This is going to take a long time to have a shift. Good news, it's been happening. We're watching it take place in institutions. We're watching it take place in family office. I believe it's going to take place in individual investors. I believe the kinds of changes that the administration has made or indicated they want to make over the past few weeks have set a path in motion to address access, legal, fiduciary responsibility, frivolous litigation, and otherwise. Will it happen overnight? I don't think it will. But even in the absence of those changes, it's happening.
And it's not going to happen overnight. When will we start? I mean, there are already some forms of access to these investments through 401ks and partnerships, but when will we really start to see it in 401ks, do you think?
Every day. We're in the middle of this. This is among the most interesting portions of our business. So it'll be in the billions of new origination for this year, even in the absence of clarity from an executive order, because fiduciaries who want the best for their clients are already willing to experiment, just not that much yet. And the other piece we haven't talked about is the most fundamental change that's taken place in 401k. We started in a world that was defined benefit, guaranteed income. Companies didn't like that so much because it left them on the hook and we had lots of deficits and we had lots of issues. We moved to a defined contribution world. Well, guess what? Individuals didn't like that so much. Most individuals do not make any decision with respect to their 401k. They simply default into whatever options. They don't manage it actively. They really do not engage with it in the right way. I think the journey we're on is not just for more choice in 401k, because it's not clear to me more choice is better. I think that for the fiduciary managers, they will do a better job managing for the 401k participants. But the world I envision is a world we went from defined benefit to defined contribution. I think we're going back to defined benefit, but not by the companies. I think we're going to see guaranteed income, particularly guaranteed lifetime income, be an important choice that individuals get to make out of their 401k. So you're not just going to choose stocks and bonds and public and private and real estate and Bitcoin and other things. You're also going to decide how much guaranteed lifetime income you want. That's another choice that needs to get made, and I believe that's something that the retirement services insurance industry will take up in a big way.
And what's driving the idea of guaranteed income? Because we've heard it in the context of what AI could bring to our society. What will you think drive that? Or is it just people want more income related as opposed to value gains?
Look, as we get closer to retirement, and think about, unfortunately for all of us, we're getting closer to retirement. But as our society gets closer to retirement and the public alternatives have not kept up, we're in a retirement income deficit. And so people will need income. Income is a fixed income product. Getting guaranteed lifetime income is as close to the defined benefit world that so many consumers wanted. And if you look at the most successful retirement market in the world, Australia, it's not perfect. They've done a great job accumulating, but in Australia, 40% of the participants die with a significant portion of their savings intact. They don't know how long they're going to live. They're not spending it. They're not actually retiring adequately, to use the government's term. We have issues of life expectancy. We have uncertainties. The notion of guaranteed lifetime income, most individuals find very attractive.
And lastly, as we look to an AI world, some people say, well, all these companies have been allowed to stay private longer. We now have OpenAI valued at, some would say, $500 billion, 400 plus companies worth $1 billion or more just in the AI space. And some would say that those are going to be the investments that add value in the future. As other companies lose employees, as the economy starts to get weaker from an employment perspective, you have to be invested in AI. And that staying private has basically blocked so many retail investors from being able to participate in the AI boom because they're all private. What do you say to those who say that we need to democratize private markets by those companies going public? That's the answer to that. And making it easier for them to go public, get rid of all the regulations around being public so that the everyday investor can participate in these 400, 500 AI companies that are now growing up.
I think, unfortunately, it's likely to go the other way. I think what we're seeing is the availability of capital in private markets is allowing companies to do a series of things: to invest for the long term, not to be driven by quarterly earnings, and to obtain massive amounts of debt and equity to finance their business plan without accessing public markets. And it is not just AI companies. The defense companies of the future, they're also still private in many instances. It will not surprise me to have large manufacturing consumer companies that are private in the future. I think we're heading to a world where we not just have private credit, but we have equity that is private, not just private equity. Private equity historically has been with leverage and concentrated bets and in funds. But it will not surprise me to see not just AI and SpaceX and a number of other companies private. Why won't there be 100 industrial companies that are private that people get to invest in? It will not surprise me that we end up with an S&P 500 index and an index of companies that are private. I think what we're going to see, and not everyone will be excited about this, I think we're going to see more transparency, more market making, more liquidity, more access. And I think the steps that this administration has taken are actually putting us down that path. It's not going to happen overnight, but for us, I'm excited about where we're going. There's no market in the world where transparency and opening up the market has not brought better access, lower prices, weeded out the poor managers and people who were not able to compete and were competing in the shadows.
So that famous chart that shows the number of private equity-backed private firms versus public firms crossing, and there are now twice as many private equity-backed firms than there are public firms. You don't see those trend lines changing. You don't see the public companies regaining a majority share.
I don't. I actually think it's going to go the other way. Think about what's happened in our equity markets. We're now 60, 70% indexed, ETFs, open-ended mutual funds. Why do they need the next $5 or $10 billion public company? Why does it, and then the corollary to that is, why does a small private company need to go public if no one's going to own their stock? We are in an indexed and correlated world. We can like that or not like that. But as active management has declined, so has the capacity of investors to analyze these smaller public companies. We are in a big market with big market companies. When 10 companies are 40% of the S&P, why do we need this next 4001 company? I just think we're seeing that. That doesn't mean we won't get some. That doesn't mean there's not a massive public market for some of the private companies who are truly revolutionary. But I think as a general trend, we're going to see more companies stay private longer, and they simply have more alternatives. And I think what the administration is doing by providing access to this market to retirees in 401k so they level the playing field is exactly the right thing to do.
Great. Mark Rowan, thank you so much for your time
today. Total pleasure.
It.